Hello, you're watching Global Insights with me, Punita Kumar Sinha. In the last episode, we discussed the future of Europe. Today, we look at another economy whose global significance cannot be understated, and yet it seems to be losing ground. The China commotion has caused enough confusion in world markets. Can China be the engine of growth, or will it remain the elephant in the room? The key questions we're going to discuss today are: does the Chinese stock market reflect China's economic fundamentals? Is the transition to a domestic-led economic model working for China? And with high debt and booming property markets, is China a bubble waiting to burst? Joining us today are an esteemed panel of China experts. We have with us Mr. David Dollar, Senior Fellow from Brookings Institution in Washington, D.C., Kenneth Akintewe, Senior Investment Manager, Aberdeen Asset Management for Singapore, and Tai Hui, MD, Chief Market Strategist, JPMorgan Asset Management Asia, joining us from Hong Kong. Gentlemen, welcome. David, my first question comes to you. You've said that the link between the Chinese stock market and the real economy is not very tight. Could you elaborate?
Well, everywhere in the world, the link between the real economy and the stock market is not always tight. So we see stock markets often disconnected from the real economy. That's particularly true in China. For a long time, the stock market was pretty small. It mostly was state enterprises that had sold a few shares on the market. So it was not representative of the whole economy. Since the global financial crisis, China's economy has been growing very well until recently. But actually the stock market was quite flat and gradually declining. And then over the last year, the real economy slowed down, but suddenly the stock market took off. So in China, the stock market seems very disconnected from the real economy.
So David, what do you make of the GDP numbers? Do you worry that the data might be masking the slowdown in the real economy?
I don't think the data are deliberately manipulated, but I think there are some problems in Chinese data. There's some interesting price developments going on, and they may not be capturing that fully in their real GDP data. I think their nominal GDP data are pretty good, but I'm not sure how well they're capturing the deflation that's going on for their industrial sector. So it's possible the real growth is a little bit slower, but I wouldn't get too excited about that. The main point is that China's economy is slowing down. It's growing somewhere between 6 and 7. It seems to be stabilizing now. So I think whether it stabilizes at 6 or stabilizes at 7, that's not that big a deal. You know, the big issue was it going to continue to decline in a steep fashion? That seems to have stopped for the moment.
And Tai, what do you make of the stock market rally in the first half of the year that we've seen?
Well, I think the stock market rally in China in the first half of the year has to some extent impacted on the economy in a positive way. If you look at the GDP growth of the second quarter at 7%, which seems unusual given the fact that we've seen fixed asset investments slow down, consumption slow down, but yet we still managed to get a respectable growth number. I think the financial service sector has been helped by the stock market or buoyant stock market activity, obviously generating greater volume in transactions. And also the fact is the positive wealth effect of the stock market rally did have also positive impact, feeding some of that wealth back into the real estate market as well as consumption. So I think, the stock market has always been an interesting wealth generator for the shorter term, but I don't necessarily think that this is going to be a near or a major factor that will drive the economy in the longer run.
And Kenneth, what do you make of the property market bubble or the high leverage in the economy? Doesn't that raise a red flag?
There's an element of truth behind that. The property market was another sector that had pretty high valuations, and obviously we've been seeing that correcting for quite an extended period of time. But again, if you focus on the underlying structural demand for property, the fundamental factors, over the coming years, there's going to be a very high level of demand for property. So it's no surprise that probably over the next few months, we'll begin to see some stabilization in the property sector. In fact, we may already be beginning to see that in the sort of tier 1, tier 2 cities. We've already been seeing some stability in pricing and some pickup in demand. But definitely a correction was warranted because previous levels of valuations and supply were definitely a little bit stretched.
And David, turning to you again, so what are the troubled parts of the economy that worry you?
Well, for a long time, they had quite a real estate boom. And I think many of us worried that they had a bubble developing. Prices were going up very rapidly. It's a big part of their economy to construct apartments. It got to the point where about 1/5 of urban apartments were empty. So that's quite worrying. They've done a good job now stopping the real estate bubble. They managed to do that without a big decline in prices. So there's been a little bit of decline in prices, but mostly real estate has stabilized. But construction activity is way down now. There's so many extra apartments in China. There's not a lot of need to construct new apartments, or not as much need as in the past. So that's probably the main reason why the economy slowed down, is that they overbuilt the housing stock. Now there's a correction. One reason the stock market took off probably was that households stopped putting their money in real estate because prospects do not look so good. So all of a sudden, a lot of people started putting their money in the stock market. Even though the real economy was slowing down, that stock market really took off. It's still up about 100% from a year ago, even after this recent correction.
But what about the high leverage in the economy? Are you concerned about the banking sector, though?
Yeah, I'm concerned about the high leverage in the economy. That over the last 5-6 years, the total leverage has gone from about 150% of the economy to 250% of the economy. So that's a pretty big increase. It makes China similar to developed countries like the United States, quite different than other developing countries. I don't think there's another developing country where you have that kind of leverage. So I worry that they have problems with supervising their banks, really knowing what's going on, knowing what the non-performing loans are. So that's definitely a risk in the economy. They've been trying to bring down the leverage. I would say they've managed to stabilize the growth of credit at about the same rate as the growth of GDP, but that's not bringing down the leverage, that's just stabilizing it. So I think there are continuing risks in the financial system.
David, so should global investors be worried about the ripple effects of what happens in China to other economies?
So China's going through a serious restructuring, a rebalancing, you could call it. The growth of industry is slowing down, the growth of construction is slowing down. Those were the sectors that were using a lot of imported energy and imported minerals. I think that story is going to continue. So I think China will not be the same kind of source of demand for energy and minerals that it was in the past. On the other hand, the service sectors are growing rapidly in China. If China continues to make this rebalancing away from industry towards services, that will create certain types of opportunities for other developing countries. For example, 100 million Chinese went abroad last year. I imagine a rather small share of that is going to India. But if India could attract more Chinese tourists to the Taj Mahal and the other wonderful sites in India, that's a form of stimulus for your economy. That's just one example. Chinese love movies. Probably quite a few Bollywood movies are making their way into China. If you actually got paid for that, that could be a nice export. I don't know to what extent there's a piracy problem. But there are a lot of new opportunities developing that are going to be different from the past, that are connected with service sectors and connected with consumption. India, of course, is quite a strong economy in many of the service sectors. So there could be new opportunities if China really succeeds in making this transition away from industry more towards services and consumption.
So Tai, coming back to you, what is your view on the monetary stimulus extended out to the economy?
Well, I think given the fact that we have seen inflation coming down from a 2 to 3% range all the way down to 1 to 1.5%, real interest rates in China has been rising on the back of declining inflation. And it does make sense for the People's Bank of China to relax monetary policy to some extent. At the same time, we have seen a tightening of liquidity environment in China, partly because banks have become much more conservative in lending. And therefore, again, the reduction in reserve requirements is much needed to provide the economy the liquidity it needs. Of course, they always have to balance that against not allowing loan growth to explode once more, like we saw back in 2000, 2010. But nonetheless, I think we do need some fine-tuning of monetary policy stimulus in order to maintain the economic growth that the Chinese authorities would like to achieve.
There is a lot of smart money in the US that is sounding very alarmist about the situation in China. Would you agree with that view?
Well, I think it's a maturing process for the Chinese economy. After all, the Chinese economy is still very much in its, infancy, it's a growing stage. It's dominated by retail investors on a transaction or volume basis. So I think, there needs to be more developments from that perspective. And, for those who are investing in the Chinese onshore market, it's a little bit of a buyer beware market. And therefore, we believe that for those who wants to have a more, a better risk-adjusted return, perhaps the offshore market in Hong Kong, the H-share markets, is a better place to be.
Our focus is primarily on the bond markets, and we still find that Chinese bonds are probably one of the better allocations within the Asian debt markets.
Investors remain, somewhat optimistic. They understand where China's going. So if you look at where foreign investment is going, it's all aimed at the domestic market.
If you look at the Shanghai market or even the Hong Kong market, overall, I don't think the valuation is particularly high, especially given the recent episodes of market correction.
Coming back to you, in light of all of this, where do you see the investment opportunities?
Well, we think that for investors who are looking to invest in China, they should focus on some of the long-term investment themes, where there is consumerism in China, which we still see a rapidly growing middle class who are willing to spend. We're looking at the One Belt, One Road concept, where is obviously a very important strategic initiative from President Xi Jinping and his team. So infrastructure and associated, construction, that's another very important area. Healthcare, that's, again, a huge part of the upcoming, consumerism by Chinese consumers. As the real estate market continues to stabilize, we're also starting to become more positive on Chinese real estate developers.
Kenneth, you obviously like the bond markets, but how are you assessing the credit risk in the bonds, both sovereign and corporate? And would you stay away or would you buy?
So, our focus is primarily on the bond markets, and we still find that Chinese bonds are probably one of the better allocations within the Asian debt markets. Obviously, the slower growth environment will encourage policymakers to ease policy, and that provides support to the bonds. And the currency has one of the lowest volatilities in the EM world, so in an environment of high volatility, it's actually quite an attractive allocation to have in a portfolio. As far as the equity market is concerned, obviously there was a very sharp run-up in valuations, and you're now seeing a lot of that getting given back, to the extent that anyone who invested any time over the last 9 years to 12 months ago would be still sitting on pretty decent gains. It shouldn't really come as a surprise that we're witnessing a little bit of a correction in valuations.
David, coming back to you, what investment opportunities do you see in China?
Well, what I see is that investors remain somewhat optimistic. They understand where China's going. So if you look at where foreign investment is going, it's all aimed at the domestic market. China as a big export platform, I think that story is over. China's the biggest exporter in the world. And what that means is its exports really cannot grow much faster than global trade. Global trade's growing at about 3%. China's exports are growing at about 2%. I think that export story is largely over. And the new story is producing for the Chinese domestic market. And there are some niches where that's allowed, but there are a lot of areas that are protected and they could open up and they could get a lot more dynamism. So when I talk to the foreign investors going into China, I see them mostly producing for the domestic market, this expanding Chinese middle class, and most of that services. That's why I emphasize the service sectors. That middle class consumption is mostly services. People want to travel, they want better financial services, they want better telecommunications, they want better logistics. All of those are important service sectors.
So at current valuations, should investors buy more or exit Chinese markets?
Well, so nobody can know where stock markets are going to go. If I knew that, I'd be living on my own private island, okay? But I think that we can say that the valuation still looks somewhat high in China. So in the long run, I think the valuations matter a lot, and they do seem somewhat high. In the short run, you can get euphoria in either direction. We obviously had tremendous euphoria in China pushing the market up, and then there was pessimism set in, and it dropped very sharply, about 1/3 in just a few weeks, so that was pretty scary. Now it seems to have stabilized, but as I said, it's stabilized at what are pretty high valuations. So I guess personally I would be careful. I prefer to look at long-term trends. If they did more to get their real economy stable and making this transition we discussed toward service sectors, they could create a healthy foundation for the stock market.
And Tai, I wanted your view on the valuations of the Chinese market, because the state-owned enterprises are still cheap, but the new economy and consumer-led companies are quite expensive.
Well, I think if you look at the Chinese stock market, the Shenzhen stock market is much more dominated by smaller companies and startups. Valuation there is still fairly lofty. But if you look at the Shanghai market or even the Hong Kong market, overall, I don't think the valuation is particularly high, especially given the recent episodes of market correction. Now, the sectors I've mentioned earlier, relatively speaking, they may be slightly on the high side if you compare their price to earnings. However, if you look back to the last several years, I don't think investors are shy to pay a bit of a premium for growth that they can see, rather than, looking for a bargain or discounts if they don't feel particularly upbeat on the sector's outlook.
So Tai, what would you be recommending to investors? Would you recommend that they add in these corrections in China, or would you recommend that they exit for now and then enter later on?
Well, I do think that investors could continue to build a position in China and India, but obviously with the case of China, they also need to bear in mind the high volatility as well. So I think, the dollar cost averaging into a Chinese market makes sense. For India, we believe that, again, between now and perhaps, when the Fed hike comes in September, I think that also could be an interesting opportunity for investors to, add to their position in Indian equities.
Final round of questions for all three of you. Kenneth, first to you. China versus India, macro and micro. How do you see the risk reward of both of these markets?
Yeah, I mean, it's interesting because we tend to always hear, that comparison being made, China and India, and there are some comparisons. Both of their markets are domestically driven, tend to be driven more by domestic policies rather than exogenous factors. And again, in the world we're going to be living in for the next few months, where there's a lot of exogenous risk, that is actually a good thing, because it means that these markets have the lowest correlations to other global markets. Both China and India, in fact, have very low correlations to global bond markets and, to an extent, to global FX. So if you add these countries into your portfolio, you improve the diversification in your portfolio to a very large degree. I guess other similarities would be the fact that, people struggle with the official levels of growth, both in China, 7%, India, 7%. If you look at underlying indicators, it would suggest that the levels of growth in both the economies is not actually what the official data suggests. And I think the policymakers in both countries know this, and therefore policy will be biased both in India and China to become more supportive of growth. And certainly in India, where you still have the policy rate quite high above inflation, if we can get through this period of uncertainty around the monsoon, uncertainty around global oil prices, for example, then the RBI, the Reserve Bank of India, certainly has room to ease the monetary policy rate further, and that will still provide a lot of support to the bond market. And as far as the currencies go, we still expect the Indian rupee and the Chinese yuan to be some of the more stable currency allocations within both Asia and the EM world in particular.
And Tai, where would you be more overweight, India or China?
I think we have similar view on both markets.
And David, bullish or bearish on China? Your view?
I think the most likely outcome is China will continue to grow well in the 6 to 7% range. But there certainly are risks on the downside, particularly if they don't move more aggressively on reform.
Well, thank you all for joining us today. As we've heard from our panel of guests today, it seems that despite the worries of a slowdown, China is well positioned to transition its economy to a domestic-led model. Now we have Tanveer Gill joining in to add some data points for the Chinese markets. Tanveer, take us through what you have observed and seen, and what is the data telling us?
Well, you've been a long-term investor in China, Punita. But just looking at, the 5-year chart of the Shanghai Composite Index, it just tells you that China has come out of a prolonged period of underperformance actually. From mid-2010 to mid-2014, the market practically did nothing, and then the boom started, which gave for the Shanghai index a return of 1.5 times, or almost 150%. And for the Shenzhen index, which many are following now, again, pretty much over the same period did nothing. But since mid of 2014, the boom in the market has taken it all the way up 300%. Now, the other thing to highlight is that the markets, despite the volatility this year, there was a point in time when both the markets were likely to dip into negative territory, giving negative returns for investors from a year-to-date perspective. But the bounce back has been fairly significant. So on balance, these two markets have continued to outperform the rest of the region. Shanghai with a year-to-date return of 24%, Shenzhen with a rate of year-to-date return of about 60%. And of course, the yuan also in the offshore market has adjusted its levels. So currently trading at 6.21 after hitting a low of 6.01. And that brings me to my question for you, Punita. Being a long-term investor, somebody who understands the China market very closely, how are you looking at these swings? Because these swings have happened in the past as well, but the market always comes back in a jiffy.
Well, Tanvi, you're right. I mean, swings have happened in the past, and the Chinese market is as volatile as the Indian market. So these things had to be expected. Having said that, the rally that you've talked about, that is really limited strongly the way the numbers are. You're talking to the A-share markets. Whereas the H-share markets, where a lot of foreign investors invest, that's not rallied quite as much as the A-share market. And valuations there are therefore at a discount to the A-share market. And so many investors are now looking back at the H-share market, where there's plenty of companies with good growth and or decent valuations. So just like we see in India, there are state-owned companies where valuations are pretty good because reforms are still to happen, and then the consumer-led companies where the consumer growth has been pretty strong in China, where valuations are not so attractive, but then the growth is quite strong.
Right. Punita, so my next question to you then is that, you have the Chinese market and you have the Chinese economy, right? How much should the world be worried about how these two play out?
Well, the world definitely is impacted by China. Now, let's just focus first on the economy itself. As the economy in China has slowed down, it has created a meltdown in the financial markets and the commodities. So clearly there's a link to the Chinese economy and the financial markets in that sense. So the commodity stocks and the commodity companies are taking a big beating. In fact, look at what's happening to steel prices across the world, and steel companies are hurting as a result of that. Similarly, other commodities. And that is a trend that, unless China's economy really picks up, what happens to commodity prices is something to be watching. The other thing I think is, as China shifts its economic model from being an export-oriented economy to a domestic-led one, that creates opportunities for different countries to play different roles. So for instance, while China wants to shift away from exports, India is targeting exports, and this Make in India is something that India could gain from as China reduces its emphasis on manufacturing and India wants to increase its emphasis on manufacturing. Similarly, consumer theme in China, as the economy is focusing more and more on consumer, a lot of global companies, just like they used to invest in India, are looking more and more to invest in China so that they can benefit from the boom in the consumer side. So I think there will be shifts across the world from what happens in China. So the only pockets of growth remain India, China, and some of the large economies in Asia. So I think what happens in China is very important.
Oh, yes, it will.
Absolutely. That's it on this episode of Global Insights. We will come back next week and look at the Indian market. Is it time that India goes from being a prominent emerging market to being a prominent global market with more access to global portfolios? We will understand that next week. Thank you for watching.
I like India mostly because, well, at this moment in time, mostly because I'm a great believer that commodity prices should go down further. And India is wildly advantaged by commodity prices going down.
I think that the first thing to say about the Indian credit market is that it's had an extraordinarily good run from, let's say, the first half of last year. There was a lot of value in the first half of last year. A lot of that value has come in the credit market.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ET Now.